Welcome everyone to Coffee Break with CRIF, and thank you for joining us today. We're excited to have two industry experts with us for this conversation today. Joining us are Annie Mayers, AVP of Business Operations for Dealer Lender Solutions at Cox Automotive, and one of the key leaders behind the Dealertrack Lender Network, and Robert Cristini, SVP of Sales at CRIF Select, who also brings extensive experience from his years at Cox and now at CRIF. Today's discussion will take a closer look at what happens on the dealer side of the screen, how lenders are evaluated by dealers, and what it takes to compete effectively in today's indirect auto lending environment. A couple of quick housekeeping notes before we begin. The session is being recorded, and we'll send the recording to all registrants in the next few days. As a thank you for attending, all attendees will receive a coffee gift card after the webinar. If you have questions throughout the session, please drop them in the chat. We'll be collecting questions, and as we go, I'll save some time at the end, and we'll do a live Q&A with Andy and Rob. If we don't get to your question during the webinar, we'll follow up afterwards. With that, I'll turn it over to Robert to get us started.
Thanks, Andrea. Good afternoon, everyone, and welcome to Coffee with CRIF. Today, we're going to be talking about what's really happening with the Dealertrack network and what actually separates lenders who consistently win deals versus those who don't win deals, because we all want to win deals. So I'm currently SVP of Sales here at CRIF Select. Ironically, before joining CRIF, I spent about 20 years on the Dealertrack Cox Automotive side. So I've seen the ecosystem from just about every angle, and I've had the chance to work with many of the lenders on the call today. What makes this especially fun for me is I get to sit on this side of the conversation for a change. And I'm joined by Andy Mayers from Cox Automotive. Andy knows this space better than just about anyone. Andy and I go way back. We spent a lot of years together in this space, and somehow we've actually managed to stay friends through one major issue. He's a big Baltimore Ravens fan. I'm a huge Philadelphia Eagles fan, but I'll leave that to the side for now. But if the competition gets in the way, now you know why. All kidding aside, between the two of us, we've definitely seen how this network has evolved, and more importantly, what actually drives dealer decisions. Andy, great to have you.
Thanks, Robert. And just keep in mind, if you were a Steelers fan, we wouldn't be talking. So that's a good thing. We can tolerate some Eagles fans if we must. But anyway, I appreciate you having the opportunity to speak with you guys. And like Robert said, we worked together for a long time. For those that don't know me, I've been as part of the Dealertrack network since 2003, slinging apps, as you would say, since the beginning. But really, my focus is really in growing the lender network, how we can evolve from a technology innovation perspective. We're really excited about having the opportunity to share some ideas with you and Robert today about what dealers are talking about, and really focused on how lenders are such a critical part. I mean, Robert and I, we're together this for a long time. The lenders are such a key part of the auto finance industry. You know, there would be no SAR without lenders in auto finance. And we really want to focus today on how we can keep driving efficiency in that space. So excited to be here and look forward to having a conversation with you guys. Thanks.
Great, Andy. So let's start with something that every lender on the call is probably wondering. I know that both of us have been into a lot of F&I offices. We've watched the screens fill up with different lenders. But when a dealer sees over 20 lenders on Dealertrack, what actually determines what lender they choose, who they look at first? Because we both know it's not random, right? They're not just scrolling and hoping and just pointing to a lender that they see on the screen. What makes them work with a particular lender when they choose that lender in Dealertrack?
Robert, I think there's a number of factors. I mean, relationship is a really important thing, and this auto finance industry is really driven by relationships. You know, how a lender services a customer, being a dealer, what products they offer. Obviously, in certain transactions, it's pretty obvious. If a customer wants a lease vehicle, they're probably gonna have to go to a captive financing source. So what products the lenders offer automatically becomes a inhibitor of, who's eligible to do things. If you do business loans and someone doesn't do business loans, they're not eligible to even be selected. So that's the first. The second is the product and the customer profile. So a lot of our lenders specialize in certain areas of expertise, like prime and subprime or near prime. The amount of coverage they have, and the dealers know who has the right products for them and programs for them. But then what we're starting to see more importantly now is service, how fast a lender can decision loans, if a lender is capable of doing digital contracting, because these are things that cost the dealer time and money, and they're looking to save those things. So we see definitely a higher propensity of people that are actually a digital contracting lender being selected over a non-digital contracting lender because the dealer gets funded faster. And then, given a lot of the credit unions you do with, I mean, customers do drive that relationship as well. So there's a lot of loyalty that consumers have to their credit unions that it can actually encourage that behavior. So there's a number of factors that are driving it, but definitely relationship, the products, but the services you provide in the ability as a lender to provide fast decisions, digital contracting, other things like that, I think are some of the key drivers today.
Yeah, I couldn't agree more, especially from a dealer relationship standpoint. I know we've talked about it a lot. It's still a relationship business, right? So I think a strong dealer management team, understanding rates and programs for lenders, making sure that dealer management team's talking through how they can navigate through Dealertrack and the process and the platform is very important, as well as I'm sure on your side, the partners you have, like a CRIF, that's connected and enabling a lot of these services that Dealertrack offers.
Yeah, I think people have always thought that the Dealertrack network or the Route One network, whatever network, have always commoditized lenders. And I don't think that's really the case. To your point, Robert, I think the relationship that the lender builds with that dealer, how they compensate them, how they reward them. Everybody's programs are so complex now with risk-based pricing and things like that. There's no like, hey, everybody's got a 3% loan. Nobody, I guess, has a 3% loan right now, actually. But everybody's got a same rate. Not all deals are equal. One of the things we're hearing from dealers, those lenders that are stipping for income right now are probably not getting as much market share because it creates more friction in the process. So the decision responses that are coming back and the services that are provided by the lenders are really important. And obviously, rates do matter. I mean, you want to be competitive, but competitive is not just the rate level, but how much advance you can provide to the customer, what the compensation is, and things like that.
Well said. So let's move on to the next question, Andy. So we've both seen this happen before, right? What's the common thread among lenders who lose dealer mindshare, right? They don't even realize it's happening from what I've seen. They think everything's fine, and then they start to lose that dealer market share. The dealer starts to work more deeply with another lender. So what are some of those common things you've seen over the years?
Not to kind of duplicate my answer, but some of the same things I just talked about, like if you're not competitive with your rates, or you're slow to respond, a large percentage of our lenders do auto decisioning. And that's really important. Being the first doesn't mean you're the best all the time. So that's important to have a good decision, but not keeping up with the technologies and the capabilities. I'll give you another thing that's really important to understand. As we've seen things shift over the years, and 30 makes it seem like a long time. Thanks, Robert. But as we've seen shift, we're starting to see more consumers apply online. So as a lender, it's important that you're working with their dealer to let them know that if a customer is coming to the website to get financing before they even walk into a store, you want to make sure you're able to help support them through that process to begin with. So understand that the consumer origination process is shifting. Be where that customer is as well, which means online applications. We've even seen an emergence of what we call direct to indirect. Really good opportunity for credit union, large lenders, the opportunity to basically pre-approve a customer and then bring that customer into the dealer on behalf of the lending institution, kind of secure that relationship. So if you're bringing a good lead into the dealership, that's a great relationship opportunity. But like I said, staying current with technology and things like that. I think the next things you're going to see eventually are the lenders that are how they're going to handle fraud and what they're going to do with that. Recourse versus non-recourse loans will be important in that process. So I just think these are the things that as lenders you need to be thinking about, and stay true to that relationship part of the business, stay close, and communicate as you change your programs, communicate effectively. Because I think sometimes dealers don't recognize that when a lender shifted their buying parameters, that they know that that lender may be a good candidate for that. And sometimes they pigeonhole a lender in a certain area. But if you're expanding your portfolio, Robert, and you want to buy more business either above or below your normal buy box, make sure you communicate that to dealers, because they may not even realize you're a candidate to actually get that loan. So those are some of the things I would be thinking about from that
Well
perspective.
said. And I know you brought up a word called auto decisioning. I know it's kind of a buzzword I'm hearing a lot with the lenders I'm speaking with. Can you just give me a little bit around a percentage of maybe lenders that are now offering that? Is it really just if it's in a certain buy box that they're willing to, obviously execute on, then they roll in the auto decisioning piece? Can you maybe just touch on that a little bit more for me?
Yeah, we did some analysis on the auto decisioning process. I would say a majority of lenders are doing auto decisioning. Nobody's doing, I mean, some people are doing 100% auto decisioning. People tend not to want to decline, but some people do auto declines and auto approvals, right? It doesn't mean that you should do all auto decisioning for every loan. That's a credit risk compliance policy discussion, not for me to have. But we have seen, just to give perspective, we have some lenders that are returning responses back in 4 or 5 seconds. We have some that are responding in about 45 seconds, which I think is tolerable. About average for us is about 25 seconds. We're getting, full decision responses back on a large percentage of loans. And obviously that's very much tailored to each of the lenders' credit policies and risk tolerances and things like that. It's not as obvious as you would think in terms of, okay, everybody with a 750 FICO score above gets auto decisioned and everybody below is decisioned. Some of our lenders that do, non-prime lending are capable of doing auto decisioning just as capable, as somebody with the 750 FICO score. I think the risk tolerance of each of the lenders varies completely, varies, and that drives that. So, but it's auto decisioning's kind of a must-have when consumers are trying to do online applications. And I would say that statistically, and I'm going to be careful I say this, so don't misinterpret it, about 50% of the applications that come through our network originate online. That doesn't mean that 50% started with the customer sending it directly to a lender, but 50% of the time the customer is trying to start the application process. They see financing as something that takes too much time. So they want to eliminate that time in their car buying journey. So they actually do more online applications up front. So that's why auto decision will become more important as those consumers want to, get their decisions before they walk into a dealership.
Makes a lot of sense to me. And kind of moving on to the next one, which ties into this as well. So everywhere we're seeing higher vehicle costs, tighter credit, payment sensitivity. So how are dealers really changing the way they structure those deals? And what happens to lenders who haven't adjusted?
Well, I think, the lenders on the phone know this better than I do, but in terms of structuring deals, unfortunately, we're seeing a lot longer terms for loans. People are trying to extend it out. And it's interesting because
there, Andy, are you seeing 96 months? Is that too far
we've
out?
seen 84. We haven't really seen 96, but we've seen 84.
Not there yet.
Not there yet. I mean, that's a long time to own a car.
For sure.
But what we're trying to do, what we're seeing is, dealers are trying to get creative. The value of like an aftermarket product is much more beneficial now with the higher cost of, actually repairs and things like that. So like those lenders that are helping to allow a little bit more advance so the dealer can actually put a little more products in there, are trying to get the deals. It's a tough one. I think, when we talk to lenders, there's also other things coming to factor now. There's a lot of concerns about the gig economy type of lending, so now we're talking about the Ubers and the Amazon drivers and stuff like that are self-employed, and it's really hard to underrate the value of what they're trying to do. So it's kind of a double-edged sword. It's getting more expensive, and a lot of the incomes are not as reliable. I shouldn't use the word reliable, but like they're not as consistent. So now you're seeing more requirements for like verifying income and things like that. So it's kind of a challenge. Miraculously, if you look at SAR in May still was at like 16.2 million. So it hasn't dampened the supply. We have seen used cars be sold more, Robert, like the elevation of used cars, which means
I
which means
agree.
potentially for the lenders, older inventory in some cases, right? So these are the things that how dealers are adjusting. So for lenders who are adapting that and now maybe buying a car that a couple of years ago they wouldn't buy a car that was 5 years old, like they could consider that too old, have now expanded that to say, okay, I will buy a 5-year-old car because it's affordable. Um, it's interesting, and I don't know how many lenders on the phone are actually doing leasing, but we've heard some used car leasing is starting to emerge as an alternative to lower some of the finance expense and things like that. So I
Funny you
think
bring
from a
up.
lender's perspective, yeah, go ahead.
I mean, I feel like leasing, right? I think in today's sensitivity to payments, I see a lot more lenders looking at leasing. Are you seeing that from a Dealertrack perspective as well?
We're not as much as you would think because we're seeing more used cars being sold because of
Okay.
the affordability issue. So it's kind of the catch is that since more cars are affordable that are used, there's less leasing opportunity on those vehicles. So we haven't really necessarily seen leasing grow as much. Obviously, with EVs, EV leasing was driver last year before the tax credits went away. Now EVs are all of a sudden popular again for the last 2 months. I guess next month they may not be as popular based on oil prices. But so I don't think we've seen as much leasing as you would think as a way to counter that. But a lot of that might have to do with the fact that we're seeing a lot more used cars being sold.
Makes sense. So we've been talking about speed for years, and we've touched on it a lot
Yeah.
in this presentation so far, but the definition hasn't changed. So what does fast actually mean for a dealer today? So I know you talked about like speed, right? Approvals, notices within 25 seconds. I mean, is that the only thing around speed? Or is there other things lenders should be thinking about?
If I was a lender, I'd be more focused on how fast I could fund.
Okay.
I think if you want to pick a battleground, so to speak, Robert, getting a dealer funding faster than getting a decision back in 2 minutes versus 1 minute or 30 seconds or 3 minutes, getting money is always going to win on that one. So just, I think fast funding is probably the number one driver. If I can actually reduce my contracts in transit, if I can reduce my costs, which is obviously digital contracting is a key driver there. If I can tell a dealer that there's problems with the contract before I actually submit it, have it received, I can reduce their time and I can get deals funded faster and cleaner. And I think that's probably the number one priority. You know, I look at your screen, eliminate the need for documents return, even re-return. Tell them before they actually do it. We just launched a pilot where we can actually validate aftermarket forms before they're submitted to a lender and tell a dealer that the aftermarket form is not going to be accepted by that lender. So they need to fix that before they even send the package in. But it's a long time. You mentioned the 30 years. I think what's always stuck with me is when you talk to dealers, they think about two things, time and money, right? So no matter what, they always want to figure out how can they save time and how can they make more money. Making more money on contracts in transit is the no-brainer for them, and it's a must-have. Like I think that's the most competitive thing that most of your lenders are going to deal with. If they can't fund as fast as another lender, that could drive where an application or a contract can get funded.
Makes a lot of sense to me. And I think this is one I think lenders underestimate.
Yeah.
What are the friction points to funding that lenders don't even realize are hurting them? So like you brought up, funding, right? I mean, do you think lenders are aware of like how competitive that is in the market, that they really need to be funding as fast as they need to be to keep up with some of the other lenders that are doing it today?
I mean, I would defer to the lenders of what they know or don't know. I would expect that, attributes we've seen, I mentioned before, is capture rate when you have additional steps. I think that's probably one of the friction points in the funding process. I will bring up the thing that I think is very important for our industry is fraud. I think that fraud is going to be a friction point for everybody in the process. And we've had conversations with captives, lenders, and OEMs that are now actually sending back deals that they find to be fraudulent, which is a real problem for a dealer. So I think if a main friction point, think about somebody getting returned a $70,000 car because the lender identified fraud. to me, the friction point that our lenders and we as an industry need to solve for is how do we take fraud out of the process so that lenders don't need to send recourse down to, recourse contract back to a dealer and have a dealer holding a thing for $70,000, which inevitably does what? It creates a bad relationship experience between the dealer and the lender. So I think, friction will definitely be something we'll be addressing. And I think fraud is going to be one of those new friction points that we deal with. And I'm not talking about just synthetic fraud. I'm also talking about bust out fraud, and it's really complex out there. And the fraudsters do an amazing job of trying to represent who they are. And they do a great job, but it's costing our lending $10.7 billion we're saying the auto finance industry has in fraud. And that hits everybody. That hits dealers, that hits lenders, and ultimately hits consumers as well. So I think that's going to be the friction point we'll have to solve for soon.
Makes sense. And I also think about, dealers and looking at friction points. So like, I know we're enabling here at CRIF, deal update and alternate deal structure,
Yeah.
some additional features and functionalities that Dealertrack offers. How important is that to making sure these lenders have those enabled to make it easier to work with the dealers in those situations?
I think they're critical for just the efficiency thing. If I have to rehash a deal with your bank, Robert, when I can actually know right away whether or not my bank is going to have it approved, that's going to be the deciding factor. I mean, dealers are looking for efficiency. And I would add one more layer to this as everybody on the phone should start thinking about. Now you have the complexity of AI coming into this process, right? So what's AI going to do when it's comparing lender A and lender B, and the dealer says, "Hey, my chat GBT, tell me the best deal here." And if I can't do alternative deal structures, then I may limit myself to the opportunity to give the dealer the flexibility to work that. And I think the alternative deal structures, and I appreciate you bringing that up, that also helps with this whole affordability issue as well, because it gives a dealer an opportunity to know that maybe if I lower or raise my term, I could get more advance or some rates and things like that. It gives them the flexibility to work a more complex deal. But those are definitely tools that I think will help in the process between a dealer and a lender.
I couldn't agree more. I know I went through a shopping experience and I documented it on LinkedIn about, looking for a lease. And I went to 5 different dealerships. I used ChatGPT. I uploaded all of my rate sheets and information I got, and it compared everything, pointed out things that, I'm overpaying for versus, things that shouldn't be in the contract. So I think the buyer is coming in more educated than ever, and that's something lenders need to be aware of as they move forward.
They are. I think that's true.
So this one hits close to home for me,
Yeah.
as you know, being very much involved in Dealertrack, Cox Automotive, from building out the digital contracting. But how often does eContracting, digital contracting, actually tip the scale when dealers are choosing lenders?
It's hard to say because now with like 85% adoption of digital contracting, I can't tell you that someone's not winning the business because they don't have digital contracting unequivocally. But I think there's some things about digital contracting that aren't as intuitive. Just the fact that you can do remote signing with digital contracting, like your consumer, and my own personal experience, the last time I leased a vehicle, I walked in the dealership. My wife wasn't in the dealership. We both signed for the contract. She didn't have to come and take delivery, right? That wouldn't be possible with paper contracting. So I think digital contracting or e-contracting becomes that much more important because that's how consumers expect to interact. And I think it's really important that you have digital signing capabilities. And there's a difference between digital contracting and DocuPad and docu-signing, I should say, right? It's just capturing that signature doesn't make an authoritative version. But I think the digital contracting is now a industry standard, and I think it's kind of a non-starter. That's not to say that lenders won't get business that don't do digital contracting. I just feel like that's, like I mentioned before, the cost of funds, contracts in transit, consumers' experience to sign remotely. These are all valuable things that may lead a dealer to say, "Hey, let me do this with my lender that does get digital contracting."
Do you mind breaking out that 85% for me, Andy? So you're saying 85% of the contracts today are being done digitally, or are you saying that 85% of all contracts could be done through digital contracting if the dealers enable digital contracting?
So that's a great point. Industry-wide, about 85 to 87% of contracts are eligible to be digitally contracted.
Okay.
There are some lenders that have achieved in the high 90 percentile, 100 percentile, whatever it might be, but the eligibility of contracts. So like if you take our total addressable market of contracts that can be funded, about 85 to 87% could be digitally contracted because those lenders enable that capability. And I would say that's in the indirect space. I'm not including the true direct lending models where, a credit union might be doing direct loan with a promissory note on their own website, but I'm talking in indirect lending space.
Well, that's a big number, and I think that's something for all lenders on the line today and really need to consider is, your digital contracting strategy. And if you're not enabled for it, how do you get enabled for it in the future here?
Makes
So
sense.
you're on the inside product strategy side of things, and I know you've been doing this a long time, but what are lenders not asking for that they absolutely should be? Like, what are they should be asking to move that needle to get more business?
I think lenders need to understand, like I said before, where the consumers are actually doing their processing. Like, are they online? We should also be thinking about, as a lender, and I know we have a lot of credit unions and some large banks on the phone. How do you engage with the customer before they come into a dealership? Like, there's a lot of opportunity for you to engage with the customer and get them pre-approved before they come into a dealership. We have a great solution for that called lender referral, which is where, Robert's credit union can actually get somebody approved, lock them in, have them take that approval into the dealership and let the dealer close the loan without them really opening it up to other lenders for selection. So if I'm a lender, I'm thinking about how do I capture customers higher in the funnel. I'm going to be concerned once again about fraud, income validation. We've already beat digital contracting enough, but I think automation, speed and efficiency back for the dealers is important. But ultimately, programs you offer and compensation is important too. So a lot, but.
Agreed. And I don't think that's going away, right? I think that process is only going to speed up as we continue to move forward. As you know, the
Right.
consumer is more educated than ever before even walking into a dealership. I know there was talks about, dealerships moving away a little bit. I don't see that happening because the consumer still wants to feel the car, drive the car, be involved. It's a major purchase now with the average, car loan over, $50,000 our purchase price. So I think the consumer is still going to always want to see that vehicle at a dealership and get that test drive in before making that final purchase.
I agree with that. And I would just say that, Robert, I think the important thing is that consumers have indicated through our car buying journeys that they do want to do things like financing online because they feel it's another step in the process that's not has to be done inside of a dealership. And they are trying to save time. The consumer, as we all know for the last 20 years, the consumer wants to, the shopping time needs to go from 17 hours down to 3 hours to 5 minutes, right? Not really, but ultimately they do identify the things they can do online that will save time in a dealership, like shop for vehicles, like compare prices, like get approved for financing. Those are things that we all need to be prepared to support. So even as a lender, think about that when a consumer is shopping online, they're looking at payments because they're all using payments calculators. Like, how do you show up in that payment calculator is an important thing because you need to figure out how your rates might show up when they get compared with somebody else so that when they go to financing, they can actually select you as an alternative.
Agree. And the next one, and I want to get into it because I know we're running close to time here, but I know both of us have spent years helping lenders get onto the platform, right? But if a credit union or a bank says, we want to grow through Dealertrack, what's the first thing they need to do or to fix or do differently than someone else to grow through the Dealertrack platform? Because connecting is easy, right? Getting signed on, but competing is the hard part.
I mean, I think, and you can obviously help with this because you guys at CRIF help dealers, help lenders find dealers and things like that. I think communication, awareness, letting them know you're out there, letting them know your programs, our platform does allow our lending partners to communicate rates and programs, docs and forms, and things like that. So I do think some of it's awareness. I mean, it is a sales process, right? You're out there trying to sell indirect lending to dealers. I wouldn't hesitate. I'm not going to tell you what the pricing should be and how much compensation you should pay, but I do think awareness and communication. You guys have strategies to help CRIF lenders actually grow their application business. So maybe you can share some of your secret sauce for that. It would be good to know too. But I think that's right. Just like you have in the thing here, deepen relationships, streamline approvals, contracting, market to more dealers. Those make sense. That's right.
Agreed. I think they're all the key points here. And I really appreciate the time today, Andy. This has been great discussion. Really appreciate your insights. From my experience in the ecosystem, these are exactly the realities lenders need to understand today. But what I'd like to do is just kind of open up any Q&A. I know some people may have filled out on the chat some questions, so I'll hand it back to Andrea to see if we have any questions in the chat that we can answer for everybody on the line today.
Thank you, Robert. So far, we just have one more question, but please feel free to add them to either the Q&A or the chat. So it says, is it better for a lender to focus on adding more dealers or deepening relationships with existing dealers?
Wow, that's actually a hard question, right? Because that depends on what you want to do. Like if you want to expand your relationship, how do you want to grow your business? I guess would be the question to Andrea. Like, do you want to grow it through a deeper relationship and more transactions from a dealer you have a good relationship with? And maybe you can use that to compensate them for, a collective amount of business, as opposed to, I want 5,000 dealers to send me 2 applications. Your cost of servicing goes up when you have a lot more dealers. It's probably cheaper to actually do more transactions from the existing dealers than it is to get new dealers, because you have to enroll them and things like that. But I would leave that to the lenders to decide how they want to, grow their market.
Perfect. Thank you. I don't see any more questions coming up right now, so I think we can close it out now. Thank you, everybody, for joining us today, and a special thank you to Andy and Rob for sharing their expertise. We hope you found the discussion valuable and that it helped you understand indirect lending a little bit better. Also, as a reminder, we'll send you the recording and the coffee gift card in the next few days. Thank you again for spending part of your day with us, and have a great afternoon.
Thank you for having me. I appreciate it. Thanks, Robert.
Thanks, everybody. Have a great day.